welcome everybody. Thank you for that amazing update on the economy, Joe, and that moves us very nicely into kind of corporate and international tax. And we've taken a little different approach this time with the FD, and we've combined them because we feel like, and Chris, John, you may jump in. We feel like as the Joe talked there about how the UK needs to trade more and needs to trade more with the world, not just the EU and the US, and we're seeing that with tax more and more, aren't we? In that how the policies are aligning a lot more and are coming together. So we felt it would be a good opportunity to kind of take a different approach this time and bring UK tax and international together, and how they're working together, but sometimes competing against each other to get the right position, right?
Yeah, absolutely.
So we're going to cover today, in the time we've got together today, we're going to kind of just take a little look backwards as we head towards the budget in November. We thought we'd just take a little look back at the corporate tax roadmap that was introduced immediately after the first budget from Rachel Reeves, and have a look at what we've seen happen, some consultation documents and some responses from those. And then we'll look forward and we'll try and build on Joe's predictions for the budget and what we think we may see or not, as the case may be. John's then going to cover some international tax developments as well. And then we've seen some interesting developments from HMRC. I think we've gone through a few years, haven't we, of kind of not a great deal happening. They've been quite quiet. We haven't had too many cases on kind of key points. And we always think, and John, you may disagree, but I always think when we see some cases go through the courts, it's kind of an indication of where HMRC are going in terms of where they're focusing on certain areas. And we're certainly seeing more, I use the word targeted areas of legislation. And it's interesting to then see how that then develops through into the future budgets and beyond. So we want to cover those, and then to build on those topics, we thought it would be really useful to just do a little case study at the end, picking up on those key topics, because it's a really interesting one, isn't it, in terms of how relevant it can be and how it can impact quite a number of groups.
Yeah. No, and how often we see similar issues that we've tried to sort of roll together, and we'll cover off at least to give people a bit of an awareness that sometimes quite a simple operation could actually involve quite a lot of elements, and UK and international. So hopefully that will be helpful.
Absolutely, yeah. So first of all, an update on the corporate tax roadmap. Well, so it was published 30th of October 24, so right after budget, not far. And I think it's fair to say a lot of people were quite disappointed that we then had to wait almost a year for the industrial strategy to be released, because the two kind of go hand in hand. The corporate tax roadmap was introduced as a stability document, an opportunity to give people comfort, predictability, and certainty on where we are, but didn't really tell us a lot. It already told us what we already knew, that this is the landscape and we're not proposing to change it, which is helpful, but was kind of expected. What we now see is that we've got a whole raft of consultations that were introduced as a part of that, and some of them have now come to a close, and we will see what comes out of that, and if we get any further introductions after the budget and any kind of developments from that. And a lot of them haven't really told us a lot of anything new. However, the transfer pricing ones in particular, John, we've kind of seen a little bit come out of that, haven't we? Which may give us a steer as to where we're going to go on the next step of that journey.
Yeah, absolutely, Bev. And I think, and obviously speaking with our TP colleagues, so Chris Liu, who did provide input into that consultation, and obviously I worked with him very closely on many things, so got his sort of views on that as well. So some of the things that we've sort of seen in that, the draft legislation, and what we're expecting from the consultation. So again, sort of our predictions and could vary. We'll see what actually comes through. But the one of the positive changes we were expecting is this exemption on UK to UK transfer pricing. So it didn't necessarily cause you a tax problem, but it always or can throw up that scenario where you actually have to think about something, and maybe there's a bit of a mismatch there as well for some reason, and perhaps group relief isn't available due to the myriad of restrictions on losses, and potentially non-coterminous periods and all the other things that can really complicate what on the outside or even 10 years ago would have been a really simple, okay, well, we'll just group leaf then, that's not a problem. So that would be welcome if we removed, or if we saw that go. So, I think part of the approach, or at least the stated approach, like you said, Bev, was this point about the reforms or the proposed reforms simplifying things and hopefully, I mean, we've been hearing that, well, ever since I've been in tax. You've been hearing every government sort of say, we want to reform, we want to simplify, we want to make everything more streamlined, close the tax gap. And yeah, hopefully if these reforms do come through, it ends with a simpler sort of, approach to various things instead of an extra, X pages of legislation followed by another 100 odd pages of guidance, which unfortunately it often ends up being the outcome. But fingers crossed, we're looking at simplification here. Another point or another expectation that's probably less welcome is the potential to bring medium-sized groups fully within transfer pricing. So I'm sure you've come across this, Bev, where that medium large group sort of assessment is pretty key. It's not to say that medium groups are outside of transfer pricing; they are still subject to it, but it's not the the full on formal kind of documentation requirements unless asked. Essentially, broadly the case. Obviously, transactions with what I'd like to call sort of tax havens or the low tax jurisdictions, however you want to put it, still subject to transfer pricing regardless, but. Bringing a lot more groups that perhaps previously haven't got that experience of dealing with those transactions, so maybe haven't thought about it as much. Certainly should be on the radar. I think simplified, but sort of a wider net, and I think that might be the theme actually in the budget that we'll sort of come on to. One of the themes that runs through that. Okay, so just moving on to one of the sort of key outcomes we're kind of expecting on the permanent establishments. We've obviously got our UK domestic PE definition. It's not the simplest. It's there's only a few sections and a few pages that kind of cover it, and a lot of it looks at case law, and then you're kind of looking at the double tax treaty overlay on top of that as well. What we're expecting is the domestic definition in the UK to align more fully with the 2017 model double tax treaty definition as well. So that won't necessarily bring a lot more activities in the UK into scope of having a UK permanent establishment, but it does indicate this trend towards the newer or the modified double tax treaties with various sort of developed jurisdictions, tends to be like the Netherlands, for example. It brings us more in line with that sort of post BEPS tighter definition, so capturing a bit more, looking at things like the anti-fragmentation rules to broadly to stop artificial kind of splitting of operations to avoid PEs, but it can catch things more widely. So we're expecting to see that as well. On diverted profits tax, and I think this is most likely it's been more of a deterrent tax rather than a kind of a revenue raiser. But certainly the proposal to remove or abolish diverted profits tax and replace it with it's like a transfer pricing, in addition to transfer pricing. To go after unassessed transfer pricing profits rather than this penal, extra CT charge. So it kind of sits outside CT. So it's sort of bringing it within that framework. Again, should simplify things, I hope. But the DPT hasn't necessarily caught too many people, but it has deterred certain aggressive structures for very large multinationals that maybe were on the aggressive end of the spectrum. So it has had an effect, and sort of I think the view is it's fulfilled its purpose. Let's move, let's try and make sure we're not opening up a loophole, but also sort of bringing everything in line. So make it harder to miss, I suppose. But certainly the medium-sized groups being brought into TP, I think that is the big one to watch on that front.
I would agree. I think that's really interesting. But I think because of the definition for transfer pricing, those medium groups can actually be pretty large.
Yeah.
And I think that's where we've kind of the international legislation as part of the UK. So transfer pricing, permanent establishment, DPT. I don't know what your view is, but I don't think it's moved on as quickly as it should have done to keep up with the level of international trade. And I think that's what we're going to see as we go forward. I think there's going to be this move away from looking at domestic legislation and look at the international elements that form part of that, because I think that's a huge opportunity for the government, but also it's an area that probably hasn't been as well trodden. They tried with the DPT, didn't they?
Yeah.
And it just caught such a small portion, which was correct. But now we have BEPS and OCD and we have Pillar 2. We have to look more internationally, and most businesses have an element of international trade now, and then that has to be encouraged as a way of encouraging growth. So I think it's going to be really interesting to see over the course of the Parliament, to see if we do now really focus down on these areas. But as you've said, I kind of feel like the documentation and the administrative burden on businesses and companies is going to just become so much more.
Yeah, it's especially, well, the Pillar 2 size groups, as we'll sort of touch on with the international update. It's not simple. It's not simple. There are, every time something is brought in to try and it's the old sledgehammer to crack a nut kind of problem. How do you get that balance right? And often it's the starting point is right. We go all in, and everything's caught, and every potential avenue sort of captured there, and then maybe a bit of a sort of a walk back on certain things, or the realpolitik of dealing with sort of countries that may not be as keen comes into play, and accommodations need to be reached, so things do get watered down inevitably. But
so kind of let's think ahead then in terms of moving forward to the budget. It's getting, from a corporate tax perspective, for companies and businesses, I feel like over the recent years it's getting harder and harder to provide any predictions. And if we think about what kind of Professor Nellis said in terms of the economy needs that adrenaline shock to get it moving and to get growth going. From a corporate tax perspective, how does the Chancellor do that? And I'm not sure, there's no silver bullet here, because they've already committed to freezing rates, which I think is the right thing to do. Businesses need that certainty. They need to be able to model through. And we saw again on one of his slides the volatility that comes with, and you need to be able to plan forward. Permanent full expensing, we already know that. So we're not seeing a huge amount of innovation, dare I, kind of, without to use a bit of a pun there, with the kind of the key reliefs on R&D and patent box, where while the government are asking businesses to innovate and grow and be entrepreneurial. I'm not seeing that from a legislative perspective in terms of supporting businesses and how they do that. So it's getting really difficult, isn't it, to kind of try and see where we go next.
Yeah, I mean, there's certain things, like you say, the permanent full expensing, and we are taking it as read that all of the kind of the promises not to change things and the whole push on stability is going to be kept. I mean, there is the point, as Professor Nair said, they need to find the extra money, but CT isn't the biggest, isn't the kind of biggest revenue raiser, and there's only so much you can kind of do, and it is easier to shift behaviour and change your models to a certain extent. Some businesses can do that more easily than others. Touch on, I'm sure our VAT colleagues will touch on it later, but the effect that even the announcements of tariffs has on entire operational structures of businesses that, I've been on calls, conversations, and people, or groups looking to completely overhaul and say, well, we need to, this is going to kill us, so we need to find a way around that. So, we are taking it as read that the promises about stability will stay, and I think they will. I think the rates will stay the same. Will there be an expansion of the kind of the base? Is there some way of capturing something there? That a small change could make that wouldn't discourage people, but would also raise some more money or reduce release. I mean, R&D is not as for the smaller groups anyway, is not quite as beneficial as it was. Obviously, we had years and years of a real targeting of R&D, both the kind of legitimate claims and the sort of claims the government's saying they want to encourage, and they want people to come to the UK and develop pharmaceutical products, develop innovative new solutions to problems, but at the same time absolutely hammering them and preventing anyone from getting an R&D repayment for 2-3 years, as was the case. I think it's that blockage is being unblocked now. I think the focus is moving on to some other areas that we'll touch on later. But, you know, will there be another wholesale change to something like that? I don't think so. I don't think that,
No,
you know, it's not the right
no,
time, is it?
I would agree. I think this next budget has to be a stability one. It has to be we're not going to make any significant changes because we can't. And I think you're right. The big key reliefs and things, they've done those now.
Yeah.
The shock the R&D system needed, they feel they've done that. And that definitely has. I've definitely seen from some clients a real kind of turn down in their approach because of the extra administrative risks, which is a shame. It's a real shame. It's much harder, but I think in part reliefs it probably was needed in certain areas. So I think the budget's going to be really interesting from what is lacking from it as opposed to what are we going to have. It's the second budget, so it's a little bit more known. We've got a little bit more of a feel for where she's going. Obviously, we'll see from an interest perspective today, the interest rates, that's going to drive a lot of the behaviour over the next 2 months. And we always get plenty of leaks, right? We always get plenty of advance notice as to what's coming the day or so before. So if we move on to the international tax aspects, Emma, John's frozen on my screen. Am I still with everyone? Or is it me?
Hi, Bev. Yes, you're still live. And
Perfect.
Come back.
No, that's fine. I just
Sorry,
wanted
Bev,
to check
I missed that final point, but
no problem at all. I just wanted to check it wasn't me, Chris, John, not a problem. I was just saying, in terms of the second budget we've got now, it's a little bit more known. It's her second one, the Chancellor's second one. So we're going to have a better feel for what might come. And we always get those spoilers, don't we? Kind of the 48 hours before.
yeah.
But what's going to be interesting
if not 2 weeks before, I think these days, but it sort of start trailing a few weeks before. Yeah, we'll be there before we know it.
Agreed. So I mean, in that respect, as we talk about, and what's been interesting is we've talked about kind of focusing on that international aspect is what we're expecting to see from the international landscape.
Yeah, no, definitely. And I mean, it wouldn't be a sort of an FD update without sort of touching on the latest on Pillar 2 and the broader landscape. I mean, the past year it's been difficult. It'd be difficult to say that the US hasn't taken, you know, the world's full attention. The regular announcements on the tariffs, or the kind of the walking out on the Pillar 2 discussions, and it's not to say the previous administration was all gung-ho behind it, but they had normally said they were going to support Pillar 2. So we're kind of left with a position where the rules have been brought in. So, you know, quick reminder, it's Pillar 2 is the minimum top-up tax affecting multinational groups, so global consolidated revenue of 750 million euros or more in 2 of the last 4 years. So it's the larger corporates, but does again sort of capture a lot more groups than you might expect. So these are the rules that normally sort of meant to apply to the whole world in order to be fully effective, to stop any kind of leakage or shifting or any opportunities to do that. And the position we've got at the moment is we've got the draft legislation in you know, all the European countries now. That is the sort of the update on the EU, that they've all actually started putting pen to paper and started bringing things in. The registrations are all here. You know, deadlines have already kind of been and gone for that. If they've not been met yet, then the suggestion is, right, you know, get up to date as quickly as possible. The first domestic top-up tax returns are due, you know, in November, whether that gets pushed back, and that's in Belgium, who are always first in the line to implement all of these things. So yeah, that's one to sort of watch there, and we do have a tracker that's as you know, on the MHA pool, so we can add the link to that when we send these out. But yeah, we're left in this position where we've kind of got the US had withdrawn and said, you know, we will do whatever it takes to kind of tear this thing down, and anyone that applies these kind of top-up taxes that affect any US multinationals, US subsidiaries, that kind of thing, you know, we are going to retaliate. And you know, as we've seen, they're not afraid of kind of doing that. Last minute agreement in principle was reached to pull that back from the famous One Big Beautiful Bill. So the retaliatory measures were pulled back from that sort of at the last minute. So we've got this agreement in principle to almost treat the US guilty. So it's like their CFC regime. Yeah. It's to treat that as the same as the kind of, you know, UTPR and the top-up tax elements that capture a similar thing. Now, they're not the same. They're very different, but we're going to try and come to, or the idea at least, and there's still a little way to go, but the idea is that we'll treat them as the same, or achieving a similar effect. They are very different actually, but it's where we come to that realpolitik point. You have to like work with the world that you've got, not what you want. So that's certainly where we are on the US point anyway. So we've kind of got that agreement, but not alignment. India and China still not on board on Pillar 2, so we've got to watch that space as well. It's three of the world's biggest economies and quite others of the world that's not fully on board. But that's not to say that Pillar 2 isn't here to stay and needs to be dealt with. That isn't, there'll be a lot of news articles about US have done this or said that. Clients that are in scope need to keep pressing on. I think that's that is the real important point. Don't kind of take the US as or the US issues as something where we can say, okay, well, it probably fall away. It won't. There will still be extra requirements, so registration requirements, filing requirements, and they are all coming thick and fast. We have to. A lot of those returns are all based on information data that's kind of from earlier this year and last year. It all feeds in. So that needs to be considered there. US tariffs, I'm not going to talk too long on that. Our VAT colleagues are going to go into that into detail, and they have been tracking it very closely. We all obviously see the updates on a frequent basis. So when you're trying to figure out, well, what's the current position, it's very difficult. The announcements do seem to have slowed down somewhat, and some of the effect on these US tariffs is it's kind of the retaliation from other countries like Canada, for example. The digital services taxes that they're kind of announcing again and then pulling back from. So it's a real kind of to and fro. It's just bringing uncertainty, really, as I mentioned earlier. So hard for businesses to plan the next 6 months, let alone 3-4 years of their operations and plans to expand. I mean, if you're looking to expand into the US, you're going to pause, aren't you? Because you're thinking, what's going to happen? What's it going to look like? It's risky anyway. So I don't know if you've seen that, Bev, with any of your clients, the kind of just the uncertainty, isn't it?
Definitely. I think for quite a while now, that a lot of my clients in particular, I'm sure people listening on this call, there is an uncertainty and there's a real. I mean, I talked quite a couple of years ago when I did one of these seminars about modelling and the importance of it. And I think it's so important because you've got to be able to scenario plan now more than ever, because who knows, you do have to think almost of the absurd. What if? Because you just don't know what's going to come, and businesses can't work on that short-term basis, in my opinion. And as I've been listening to you talk about this international element, thinking about the top-up taxes that are required and the returns that are due soon, and there's so much uncertainty as to what to include and what not to include. I don't think I've ever been in a situation where there's a deadline looming and we have no idea what to do. So I think it's a really interesting time. And I think now more than ever, the ability to pull such a vast amount of information together is going to be really challenging for FDs in terms of how they manage their exposure and their risk. And this obviously, as a reminder for a lot of people, it's the really large businesses for Pillar 2, isn't it? It's the 750 million plus. So they're inevitably going to be looking at SAO as well. So to be able to sign a clean certificate while saying that they've done all their accounting correctly and their Pillar 2 returns correctly, there's so many dimensions and layers to it now. For FDs, it's a real challenge at the moment to kind of navigate that and keep going.
No, absolutely. It's
I think we've lost John for a moment. He's paused. I'm actually going to take the opportunity, because I am very conscious of time, to just kind of flick forward actually and kind of bring it back to the UK a little bit. Emma, obviously, if it's me, can you kind of give me a heads up? I'm going to bring it back to the UK a little bit because I am conscious of time and everybody's probably getting ready to take a break. Are you back with us, John?
Yep, we're back with you.
Wonderful. I did say I was going to take an executive decision. I hope that's okay, because I am conscious of time. Kind of bring it, and everybody I'm sure is desperate to go and get a coffee in kind of 10 minutes or so. To kind of bring it back to the UK a little bit, and and look at kind of some things that have been happening. But I also, these are interesting markers for me to look forward, as we not only go into the budget, but the next kind of a year or so. And we've seen some interesting approaches by HMRC, haven't we? So I think when we think back to the budget, and the Chancellor did announce that there were going to be more HMRC inspectors being trained over time, and also in the debt management section. I feel like we're starting to see the impact of that now, and kind of HMRC beefing up a little bit in terms of their numbers and their bandwidth to deal with things. So we've seen for the first time in history, and we're getting on for 10 years soon, it's about 8 years now, our first kind of potential conviction on CCO, which we've never seen. I mean, CCO and the corporate criminal offence position and the documentation that's required by companies has been in place since 2017. And it was kind of known as a paper tiger, right? Because it was there as a bit of a stick, but had never been used. And suddenly we've now seen our first case.
Yeah, so the paper tiger comment, I think it was Margaret Hodge, MP, that made that comment, if I remember.
Right.
So yeah, and the point being now that we have had that first conviction. I mean, albeit for a sort of an accountancy firm that's been linked with some egregious sort of R&D tax fraud. So that could say that the bar is very high, and the rules have had some effect, and people have got good processes in place, and they're preventing this kind of tax evasion. It could mean they're going after the enablers of these kind of schemes, and no longer letting these unscrupulous kind of cowboy firms kind of get away with giving out bad advice. Or it could be, they've had a bit of a shot across the bow. New government's come in and they've decided, right, we actually do need to start clamping down on these kind of behaviours. So yeah, it remains to be seen if this is the first of many, or just the first and last, or but there are interesting that it's actually bitten now. At least.
Agreed. And I think we've been talking to clients for a number of years, haven't we, saying, guys, this is legislation that there's an unlimited fine, potentially naming and shaming. There are implications if something, if HMRC do come knocking and you don't have the documentation in place. So I think, while I agree, I don't think we're going to see a raft of it. I think there are other areas they'll want to focus on. I do think people should kind of have it in the back of their mind that they're trying their luck. And I think the case comes to kind of the courts in 2027, I believe. So there's a little bit of time yet. And I think if it's successful, I think people should take note and start to think about, they already have probably elements of that documentation in place, but they really need to formalise it, and they need to make sure that they're applying what they say they are. So I think it's a real important one around governance that businesses need to kind of take note on.
Yeah, protects the business as well. Whether a HMRC are going to come after or not, it's good for internal governance.
Absolutely.
Make sure your employees, your contractors are across the risks and the rules.
Absolutely. And I think big one that we're going to see, and again, Professor Joe Nellis touched on it earlier, is that we have to embrace technology and we have to embrace AI. And I think this is a huge unknown, and something that's really going to hit fast in terms of how HMRC are going to adopt AI. And it's going to be really interesting to see if we get any kind of steer from that in the budget, whether there's a sneaky little consultation document, sneaky little budget notice around how they're implementing technology and AI. I'll be honest, I think it's a real cause for concern for me in terms of how they are going to ethically and morally apply it. We've always operated in the UK under a system of fairness and self-assessment. And how do they then use AI to maintain that rather than it being more targeted? So I think it's a real one for us to watch, and one that we should debate at some point as to how we engage with AI, and how HMRC apply it, and how they're allowed to use it.
Yeah, I mean, it could be the next consultation document that comes out, couldn't it, in November, December, and asking for input, because it's such a massive thing. I mean, we've already seen how it's come on in the last 2-3 years, so you can project forward in 3 years and think, well, can you feed in data, and within a few seconds, an AI system can, on HMRC's behalf, spot various kind of problems that might have gone under the radar, they might not have. Or it might be an inadvertent error that no human could have picked up, but having millions of data sets, the AI can just see those trends and that kind of thing. But it is a move away from that human inspector actually looking at things, and the whole idea that even a penalty notice, does a human needs to actually have looked and kind of done that. So yeah, be interesting to see how that does develop. I think it's massive potential.
Agreed. I think we're in for a few years of pain in terms of as it starts to come in, and we kind of maybe start to see businesses being asked questions that, not that they're not sensible, but they're kind of a bit unusual. And like you say, if an inspector would have picked it up and we had that human interaction, there's more of a commercial conversation. I think it might be a little bit by death by spreadsheet, a little bit, I think, until AI catches up and develops and becomes more sophisticated. But I think it's a really interesting one that we have to keep on the agenda every time, not only we talk to clients, but FDs as well. How are they using our AI in the business, and how is technology being used within the business? How does that then interact with anything that HMRC use in terms of, do we get cross purposes? Do we get those hallucinations that then cause unnecessary conversations and time for FDs to be able to do the day job? So I think that's a real big one for me. And if we don't get any kind of steer or consultation or budget notice this time, I think maybe the professions need to push that and say, we need to have an open dialogue with you here on how this is going to work.
Absolutely.
Yeah.
Conscious of time, should we rush through?
Let's rush through unallowable purpose. So we've kind of picked this as a bit of a technical one, haven't we? Because this is where we've seen probably the most cases recently. And it's an interesting one because unallowable purpose has been around for a long time. It's not a new piece of legislation, and it's your first attempt at interest deduction. It's the first thing you should think about, but it's often given as a given that it's not an unallowable purpose. So the cases have been really interesting, haven't they? Because they've looked at, is there a tax avoidance motive? And even if there's a hint of one, it's starting to look at, well, actually, that's potentially unallowable.
Yeah, so I think what we got to watch for here, or what we want everyone to kind of be aware of, is well, there's a few points. One of which it's not just the really kind of ludicrous, aggressive, artificial, million kind of different sort of transactions that are just back-to-back conduit kind of arrangements. It is wider than that. Again, from the recent case law, it's and the HMRC, we understand, are now turning their attention to this. So it's something that you'd always consider. And like you say, Bev, unallowable purpose, you think of first, you say, right, unallowable purpose, is this something that obviously artificial here or non-commercial, and then often you kind of get comfortable quite quickly on that in many cases. Now I think you just need to spend longer on it, and to really make sure that not only do you have that commercial purpose, that that's documented in case of challenge. Yes. It's something you need to look at every year as well. So it's not something that you just go one and done. We've set that up. Let's move on. It's something you do need to think about and keep on top of as part of your regular review. And although we're running short time, I think we're going to sort of touch on a few of those points in practice about kind of refinancing. So
yeah, agreed. Yeah, just while we click on to the case study, and we will kind of maybe rattle through a few slides and just talk through the structure one at the end. As part of some of the cases that we've seen, so I think BlackRock, QuickFit, they've looked at documentation. HMRC have actually requested board minutes and read into the board minutes. So I think that documentation is critical. And that's not to say it should be crafted, but they will look at what was discussed and what was the purpose of that loan. And even if there's a hint in there that, well, actually it gives us a better tax position, they're hanging on to that. And almost taking it out of context a little bit at times, but they have been successful in that approach. So it's an interesting one, because unallowable purpose we just take as a given, but we can't anymore. Everybody jumps down to the more techie stuff, TP, ThinCap, CIR, but actually you need to start right at the top. So maybe if we jump into the case study, shall I maybe click onto the next slide? Because that's probably, there we go, we can talk through that, can't we? So what we have here is what we think is quite a typical structure. You've got bank lending into a UK company, which then pushes down to various entities. And what they're looking at doing now is effectively consolidating all of that debt into a treasury company by interposing one there. So we've kind of taken it as a given, haven't we, that the structure of getting the treasury company in place would be a share for share, and we don't want to concentrate on that today. What we wanted to just talk through briefly was actually the interest deductibility issues that can arise from trying to consolidate those debts.
Yeah, so I think probably if we roll on to the next slide, Bev, we can. Yeah, so we can, and everyone can kind of take this away. I think the point we want to get across really is a lot of the time you have your group structure, and over time the intercompany balances can become quite messy. You know, every year, you know, something happens. There's a trade balance that gets converted into a longer term loan or intercompany debt. You can have back and forth. You know, the position can become really messy. It's good sort of internal governance and financial hygiene to kind of take it to stop and look and kind of at least assess whether there would be a benefit to tidying everything up. Now, some of the reasons we're sort of saying that, because these, if it's a UK group and just UK is UK, perhaps there's not so much of an issue there. There may be when it comes to paying a dividend, and you might look and say, our reserves position is not great. Why is that? And, lots to think about there. But when you introduce that overseas element as well, you may find it harder to kind of tidy up quickly. There might be quite a few more steps to go through to do that. So it's really bringing out the importance of doing this exercise on at least a sort of semi-regular basis to look, assess, and say, have we got withholding tax leakage on these kind of transaction flows and interest that we're paying up? Is it costing us more than it really should be? Do we have interest that we're paying from the UK overseas that that we're suffering withholding tax on, that really we've got leakage all over the group, that if we stop, do the exercise, okay, there's some work to do to get everything there and kind of right side everything, bring it all into a treasury company, have some streamlining there, mitigate the withholding tax, deal with any accrued interest and older balances, fix the reserves positions of various groups. There's a lot of benefits you can get from this, and you're saving your internal stakeholders and internal accounting and finance teams. I think I've seen some of this kind of, from discussions, having to deal with these massive spreadsheets, or if they've got a spreadsheet summarizing everything, dealing with these kind of intercompany loan matrices, and it really can be a worthwhile exercise, kind of looking at that and really tidying everything up and getting on top of it. Conscious of time, Bev. I know we've run over slightly, but we've kind of added the comments on the slide. So we do have the various things to consider: unallowable purpose, transfer pricing. Chris Lou would kill me if I didn't mention that again. Thin cap, CIR. So a lot of people on this call may have discussed with myself, Bev, many of our other colleagues, kind of the issues on that alone can be quite complex. And then when you've got the overseas element, you have to factor in various overseas nuances as well. So, the hidden distributions and overseas transfer taxes. I mean, there's a whole plethora of things that can come in and bite you. You could fall into those traps. So, we're on hand to help whenever, as required.
I think this kind of just brings the whole thing full circle for me, in terms of, as we now move again in towards this more international trade, and it's the only way to encourage growth, is you have to look at how you consolidate your balances. There's some legacy balances all over the place, and being able to, when you're looking at your globe returns, right, Chris, as you've now kind of joined us, and you're looking at your implications of Pillar 2 and where you've got balances, and transfer pricing might be extended to medium businesses. I think this is just going to continue to be a bigger area of concern, and knowing what you've got where is going to be vital, right, moving forwards, to be able to manage those exposures with this constant moving feast of who's in and who's out of the Pillar 2 returns and the regime, and who isn't. It's going to be huge.
Fantastic. Yeah, no, some great insights there, Bev and Jonathan. Thank you very much indeed. There were some great comments as well about the tax environment here in the UK, and what does the Chancellor do in late November on this front, needing to stimulate growth but needing short-term tax takes, etc. Myself and Joan Ellis have written about following the Irish model of a low rate that can bring in significantly more CT rates, but needs to be a long-term strategy. Don't expect to see that in the short term, but would love to see that in the long term.